after. Hi, everybody. Sorry, we're having some technical difficulties. It said broadcast failed. We're going to try this again. So I'm Amy Novakovich. This is Jim. Hi. Thank you for joining us, Nova Wealth Management, our Facebook page. Like us on Facebook. Follow us on Twitter at Nova Wealth Management, MGMT, KRT. What else? Twitter. I'm on Twitter.
I'm on Twitter.
Novakovich Amy. At Jim Novakovich. Mm-hmm. We also have a YouTube channel. Subscribe to our YouTube channel for quick, 90-second tips. I got to start doing them daily, but there's a ton on there already. So our YouTube channel, Nova Wealth Management. And then, what else do we have? Hey, how are you? Hi, Ed. I think that's it. Oh, our podcast, The Nova Wealth Show. It's on iTunes. So, and the Wooditch Network. There's a video version of the podcast on the Wooditch Network. So, okay, let's get into it because this is kind of an impromptu pre-Finance Friday. Just talking about the market, obviously.
Is that your water?
Yes. If you've had a TV on today, then you probably know the market was down over 1,000 points again today.
Remember a couple years ago when the last half hour of every trading day was just like
nuts?
That's what it's been. I think that's back.
Yeah, the volatility is crazy. There's so many things that are going through people's minds. So we just want to kind of get ahead of it. We want to go over what we think is happening, where we think we're going, and then a couple of strategies that we're using, which is not advice. We're not giving you investment advice, but we are giving you general information just so you know that some things are out there, maybe give you something to research and see if something works for you and your strategy. So as far as what's going on in the market, I think obviously they keep saying it's because of a little interest rate rising. The Treasury interest rates are rising. I don't buy that at all. We've seen Treasury rates rise originally. So this is what we kind of think.
That's not the problem.
Right. So last week, Treasury rates went up. The Fed chairman has switched. So historically, over the last 6 or 7 times, the market has gone down actually when the Fed chair switches. Also, initially, what happened was we had this big down day, right? It was 450 points last Tuesday, I think it was. And because of interest rates rising, and then what happens is people start panicking a little bit because we haven't had a day like that in 2 years. So people put stop losses on. Margin calls start getting called. If you're not familiar with margin, it's just essentially borrowing from your investment firm. A lot of red on that screen. But so margin calls are generated, so then the computers kick in and it just starts going crazy. And I think after that, it's really just negativity in the market. It's just really what they call a technical sell-off, where it's just time to have a pullback. We're just kind of due, because the economy did not change overnight. What are you seeing? What were you going?
Well, Take-Two Interactive is down 11%. So
right
that's
now,
not fun.
Or today?
Right now. Well,
that's after hours.
No, this is today.
Oh, today.
Yeah. So it's been a crazy time. I'm sorry, were you finished with your?
I was finished with my thought.
Oh, good.
So what are we doing? So what are some of the strategies that we're doing? So we mentioned last Friday that we've been buying puts, which we did. That we sold some to generate some cash. I actually did that on Tuesday to generate some cash to buy if and when we feel like it's ironed out. Why don't you go over, the reason why I roll my eyes is because I feel like you're going to get all complicated, but why don't you go over...
Because it's not easy to explain.
It's not. But we do get creative with options. There's a lot of things that you can do with options. So why don't you try to explain the collar.
Okay.
And see if we can break it down.
Okay, it's a collar. So we have some clients that own the SPY, which is the S&P 500, which is...
the market.
Yeah, it's an index. What we would do is, this kind of volatility, we want to step aside. We want to get out of the way of this volatility because I could see this being another January of 16 again.
Right, but when you say get out of the way of the volatility, you don't say it like that, because then to me it sounds like, oh, you mean go to all cash, which is not what you mean.
No.
You mean put on a hedge in some way, shape, or form.
We're going to put a hedge on.
Yeah.
Maybe benefit if it goes down. So
right.
The way it works is, what you do is, the SPY, for example, can I give you real numbers here? Let me see if they're bidding. Probably not.
Why does that? Just make up an...
Yeah, it's after hours, so you don't get accurate option bids. So the SPY, the SP 500, is trading at 259.55. So what you could do is if you were in the market, you could be in the market, you could buy a put. So if it's at 259.55, maybe you sell the put. You buy the put.
You buy the put.
Buy the 259 put. And then you sell maybe the 262 call.
To pay for the price of the put. So when you sell a call, you bring in premium because you're the seller, and it helps offset the cost of the put. And if you're not familiar with what options are, then maybe we do one of two things. We have a course coming out on options, so watch our course if you really want to get into options. If you're not familiar on options and you are not familiar on investing as a whole, then maybe you just stay away from this strategy, and maybe it's as simple for you as to buy on the dip. So one strategy that we have said to some clients is that we wait until the volatility kind of irons out a little bit, and then we buy. This is a buying opportunity. I mean, I don't know if it's going to go down further, but it's nice to know you're buying on a 10% pullback. Whether it goes down 15, to me, especially if your time horizon is long term, to me it makes sense to just make sure I'm buying at least on the 10% pullback, because in a heartbeat, the market could go up 700 points tomorrow and you've missed it. You haven't completely missed it. But that's why you need to buy when you get opportunities like this to take advantage, because otherwise you're just riding it out all the way, which you can do. You won't get hurt, but you're not going to make a ton of money. Like, this is how people really make their money, like taking advantage of swings like this. So going back to the options.
With this caller, though, you could essentially put yourself in timeout for, and it was the March 23rd that we did it. Or it was the 23rd.
Okay.
So 43 days out. So when you buy the put, when you buy the 259 put, you're reserving the right to sell your shares at 259.
The put gives you the right. It's a contract, and it gives you the right to sell your shares.
And that works out in your favor if the market really drops. If the market drops dramatically, and say it drops to 230, then you can turn and sell those shares at 259.
Right.
As long as it's before expiration, which in this case is 43 days away.
Which is good. You go out and buy it low, where it's at in the market, and then you bought a contract.
Well, in this example, we already own it, actually.
Oh, I'm sorry.
Yeah. So we already own the shares. So what we want to do is protect those shares.
Right.
So we buy the put. We sell the call. We sell the higher call, and what that does is that means if the stock goes up, we're going to have to sell our shares. When you sell a call, you'll have to sell those shares if the stock goes above that strike price.
So
we're essentially putting ourselves in a little bucket. We know we're not going to make more than 263, but we're not going to lose more than 259. We're in timeout for the next 43 days.
That's why they call it a collar, because you're limiting your upside, but you're protecting your downside. So you get the best of, I shouldn't say the best of both worlds. You get both worlds, not the best of both worlds. You don't get the best of the upside. But it's a way that you can protect your risk, like you said, just sitting in timeout. So if you're just joining us, we're talking about the market, what's going on, what you should do. So I think we definitely covered a few strategies already that you can do. And again, these are not recommendations, but some things that you can do, right? You can buy on the downturn. Even though it may go down further, you know you're buying on a dip. You can put some cash to the sidelines. I would not recommend jumping all out to jump all back in, because your timing won't ever be right. But if you generate some cash, sit on the side and buy when the market is down. That's a good strategy too. Hey, Marcy, thanks for joining.
Staying on that synthetic, though,
That's not the synthetic, that's the collar.
The collar. The way you make money, speaking of, you had mentioned buying on the dips. So in that example, the market goes to 230. By March 23rd, we could sell our shares at 259.
Generate some cash.
Generate the cash, then you buy at 230. Mm-hmm. So that's really how that would play out.
Right.
If that market really drops like that.
The ultimate moral of this story is that if you, hey Johnny, thanks for joining. The ultimate moral of this story is that there is not a clear, definitive reason why the market is crashing the way it is. It's not like
that's for sure.
It's not like some awful news came out last week and it's just been downward spiral. Hey Lisa. So when this happens, when something like this happens, it's more of an opportunity. The question is, when will it end? We don't know. We don't know if it's 2 weeks. We don't know if it's 6 weeks. So sometimes it can continue for a while because of the computer trading we mentioned. So you just have to find what works best for you on how you can take advantage. And I really feel like something needs to be said about your 401k account. So not just if you have this random investment account. Obviously, you can do, we talked about some option strategies and buying some equities when they're down. Obviously, those are something in an investment account. But within 401k accounts with your corporations and your companies, hey Mark, thanks for hopping on. Within corporations and your companies, keep in mind, you are still putting money in every couple of weeks of payroll, right? So you're buying when you're down. So you may not need to do this drastic, what we're saying right now. We're saying, you buy on the dip, you use a collar in options, right. You buy some puts,
401ks,
we're getting fancy. 401ks what?
You leave alone.
Well, unless, like what I did yesterday with a client. So I have several clients that do have 401ks. They had their money in all conservative stuff. So I just brought it up, just saying, you know, it's possible you could move some of the safe stuff in your 401k to be more aggressive in the stocks for now. And the trade actually executed at end of day today because that was after business hours. So it really worked out. We hoped for a pullback. So this whole thing is because of me. No, just kidding. I wished for a pullback. But anyway, so you take your more aggressive stance just for a little while to take advantage of this pullback, and then once it rallies back, if and when that happens, then you take that money and put it back to your safe stuff. But, that's kind of getting fancy, but I'm just saying you might want to talk to your professional about what you should do to take advantage, because what I don't want you to do and what I don't think you should do is just do nothing. I don't think.
In a 401k, you could just do nothing. If you're allocated correctly.
If you're diversified.
Yeah. He was too
super diversified.
Conservative anyway.
But I mean, in your investment accounts, make sure that your advisor is active and at least taking advantage and aware of these dips. You're not getting just the answer of, oh, it'll be fine, you're diversified. Oh, just write it out, it'll be okay. Like I just don't think that that's right, and I guess that's just our opinion, but I feel like these opportunities don't come along often, so it's imperative that you, in some way, shape, or form, again, talk to your professionals, take advantage of this pullback. And so I think
the question is, when is the market going to be at the bottom? I mean,
when is it going to be at the bottom? And we don't know.
And nobody knows. You turn the TV on and, it was funny. Was it yesterday the market was green for some of the day, or the day before? I don't know. There was a couple times over the last few days we've had so much volatility.
Yeah.
There's a couple times during the day. It was in the afternoon. It was
2 days ago the market closed up 580 points.
Yes, but in the morning it was down big.
Yeah.
So, it was funny, the guests on CNBC in the morning, they were all talking about protection.
Time to
in
sell.
The afternoon, every guest was saying, oh, we were buying yesterday.
Yeah.
Which was baloney. No, they weren't.
Oh, they're not out there saying that now.
Yeah, of course.
Oh, yeah, we were buying on Monday.
Yeah, so it's just funny. You gotta be careful what you see.
You gotta weed through the stuff. Right?
Yeah.
You got to find what works for you. You got to make sure that, this is not a time to panic. The economy did not change overnight. So I think if anything, that's the message that I want you to get right now, is that this is not a time to panic. This is an opportunity. The question is, how do you take advantage of the opportunity and when? You have to play that game, and I actually have a YouTube video on this, of what hurts worse, right? What hurts worse if I don't buy today and the market rebounds and I miss it, right? Or if I do buy today and the market goes down further. Right? So the other strategy is you could just put a little in today. And then if it goes down more, put a little bit more in, which is something that we do too. So there's a lot of things you can do, is the point of this video, is that you don't need to just sit still. And tax-wise, when a lot of trading is going on, you have to also be conscious of your tax consequences. If you go out there and take quick gains, it's going to be a short-term gain. So that's something that we try to be conscious of. Adelie, my 401k is still a baby and is managed and set to medium risk. It is too late to be aggressive. Is it too late to be aggressive? Okay, I was going to say, it is not too late for you.
How old are you?
Young.
She's young?
Yeah. Or could I possibly change that for temporarily? You can change it for temporarily. So if you just hopped on, Adelie, so I did say you could move some of the safer stuff to be more aggressive, or you can take your new contribution. Yeah, she's 20.
Oh, yeah.
Yeah, she's a baby. You could take some of your contributions and put the new contributions in more aggressive things. And if you don't know what to choose, call me. I'll help you walk through on what to choose. But yeah, now's the time to take advantage. It's not too late at all. The market is still very down, down 10%.
And it could go lower, though. That's the key.
It could go lower, but she's 26.
No, yeah.
Does that say 26 or 28? I can't see.
26. So the thing with someone who's in their 20s, 401k, that's money you're not supposed to touch till you're 59 and a half anyway.
Right.
So you should be buying regardless. Well, it doesn't matter what the market does this month, even this year. Doesn't matter. Your time frame is so long, just keep buying.
Just keep buying.
And buy growth.
I hope that was the message that you were giving, because I'm like, if you take two accounts and one person that just buys and holds and another person that makes an effort to buy when the market is down 10%, you're going to come out way on top. You're talking could be hundreds of thousands or millions of dollars over 30, 40 years that you're making a difference in your portfolio when you're buying when the market is down 10%. Regardless of if it wasn't the exact bottom, and it went down 15%. You still bought down 10 when you got a long-term time horizon.
I agree for someone who's 26.
Yes, okay. All right.
I'm not arguing that.
Just making sure we're on the same page.
No, but most of our average client age is considerably older than 26. No, so having the discussion about buying on a dip, our main concern is my main concern is safety.
And mine too, for those clients that are trying to maintain or trying to get income.
Yes, but buying on the dips, you just have to be very prudent. If we bought today, we wouldn't feel very good being down 1,000 points.
No, we wouldn't. But if I can always play the devil's advocate.
Go ahead.
But if we didn't buy today, like at the end of the day, and from here the market goes straight up and we miss it a little bit, that's also going to sting a little bit too. Not as much, but it would sting a little. On a lot of money, you're talking a lot of money.
No, because as a wholesale buy, I'm saying, we've bought here and there for clients over this week. We've bought for, a couple here, a couple there, individually, that we manage accounts individually. So we've made those buys, but to go in on a big block trade and get everybody back into biotech,
no,
we're not doing that until.
Is that what you think I'm saying? Because that's not what I'm saying. But
I just want some more confidence on the upside.
Jim is not confident at all in the market right now. As you can sense, I feel like, and this is rare, I feel like I normally panic in times like these.
I'm not panicking.
No, I know you're not panicking, but it's more of a negative sentiment coming from you. Like you think this pain could continue a little bit.
It is.
Whereas I almost feel like it's not real because there's no reason why it's even happening other than, we were due.
That's true.
It's just the market.
Yeah, the economy's great. The earnings season couldn't be any better.
Right.
There's every reason in the world it should go higher.
Right.
Except, interest rates are on the rise, which is
on the rise.
A little
the
headwind.
10 years at 2.8%. I mean, it's still very low, which actually might be adding to the fear because there's still a lot of room to go up. But also the Fed switching, and then they came out with the new proposal today on the debt deal. The debt ceiling. Yeah, so that could have added to the sell-off today, but that's not going to change the economy. I mean, they're trying to become more efficient in that. So I don't feel like none of this is going to put us into a recession. Interest rates on the 10-year Treasury moving a little bit is not going to shove us into a recession. So
it wouldn't surprise me if overnight we're down 700, 1,000 points on the downside overnight. We'll probably open lower. It'll come back.
It'll rally back a
tomorrow,
little bit.
yeah.
Because as you're seeing, this is another sign too, right? This is something that you can look at, by the way, when you're trying to judge if it's a full-blown, recession to the downside. When you have these swings in the middle of the day between being huge down negative and then huge up positive, that means when the market is going down, you got the buyers that are coming out. Why? Because there's volatility and they're trying to take advantage. So it's not this full-blown scary sell-off of a recession because everything is not negativity. Everything is down to the downside. 3 days ago, we had an up 500-point day. So that just tells you that there is uncertainty, which can carry on for a little while, but this is not a negative full-blown recession like in 2008.
There's no recession. The economy couldn't be better.
Right.
There's no recession. That's not a discussion.
Right. Okay, So I don't know if we have any other questions, but let's recap real quick. So we talked about why the market is going down. Why is the market going down? Nobody actually has a definitive reason, but some of the reasons we feel like it is because last week interest rates rose in the Treasury market, which puts pressure on bonds, which puts pressure on stocks, which for dividend rates and things like that. So what happens is we had a big down day, and then the momentum carries forward. So then you have margin calls come in. You have the computer trading as stop losses come in, and it just gets negative momentum. Then you hit the panic button, and you have all the people that come out and panic. Then that has the downward spiral. So we're in this, we call this a technical sell-off.
Yeah, the RSI is under 20.
Wow. See, so that's a huge buying signal too.
It
Relative
is.
Strength Index, RSI. Look it up.
Yeah, so typically when the RSI goes below 25 or 30, you could even use 30.
Typically, you know you're buying low.
That means the market's oversold.
Right.
If it gets above 70, it's
Doesn't mean it
overbought.
won't go lower, but it's a good indicator that at least, yes, you're buying low. The RSI, the Relative Strength Index. Not something we made up. It's a technical,
I invented it.
yeah, right. It's a technical indicator that people will look at when they're trying to figure out if the market is oversold or if the market is overbought. And right now, the RSI, you said it's under 20?
Yeah.
Oh my gosh.
Well,
that's
market
a
was
huge buying sign.
It is, but
Again, it doesn't mean it's not going further. We don't know how low this will go.
But if you're just an RSI guy or lady and you want to know
Yes,
if you're
thank
buying
you.
correctly, if you want to know if you're buying right, buying low and selling high, if RSI is under 20, you know you're buying low.
Yes.
It could go lower, but you could feel good about buying now.
Right. So this is not a recession. This is not a reason to panic. This is a time to do something or talk to your professionals and see what you can do. Hey, Solomon. Thank you.
I don't think there's any problem with just stepping aside and going the timeout for 30 days.
With the collar.
If you're old, with a collar, yeah.
When you say that, I feel like you're giving the message that somebody should go all to cash and then go all back in. Then you got to be right twice. That doesn't work. You gotta know when to get out, and then you gotta know when to get back in, like all in cash. If you're just raising some cash, that's fine.
Yeah. You know what? It all comes down to your time frame. If your time horizon is 10 years or 20 years, or if you're retired
Hey, Brian.
and you are going to be retired for 20, 30 years, this next 6 weeks probably isn't going to make much of a difference. Earnings are still strong. Everyone's still very bullish on the market. This is a little bit of a tantrum, and it's a give
an
back.
opportunity, and it's a time that we have to find where to take advantage and how to take advantage. So it definitely doesn't feel good, but I truly feel like this will be a memory in 6 months. Like, we'll look back, just like January of 2016. Some people don't even know. I'll bring that up in meetings and be just like January of 2016, they'll be like, what happened in January of 2016? I'll be like, the worst start to the year ever.
Ever.
The first 5 weeks was
like
down
12.
11 or 12%.
Yeah.
And people don't even remember. They forget. So I feel like that's what this will be. But you can make it memorable by taking advantage, which is what we're doing. I don't know if we're catching the exact bottom. I do not know that. But I do know I'm going to be buying on the way down.
So just make sure, if you could learn anything from these kind of experiences, because we haven't had this kind of a pullback in a few years.
Right.
Make sure you're allocated correctly. If you're allocated correctly,
What do you mean by that? Explain to people what allocated.
if your true risk tolerance is a 50% stock, 50% bonds, typically stocks are for growth, bonds are for safety. Typically. So if you're allocated properly, you don't have to take any big moves, because I don't think the economy's too strong, the earnings season's too strong for this to be a recession. There's no recession.
I made the argument that you could take some of the money out of the bonds and buy the stocks, but Jim says no.
Yeah, that's very aggressive. And if you're younger, if you're 26, take the money out of bonds and buy stock.
Yeah.
If you're 66, then I would not recommend taking anything out of safe and going risky now.
And this is so crazy. This is usually reversed. I'm usually like, oh my gosh, let's raise cash. I just feel like this is so clear.
It just depends on what your objective is. My main concern is safety for our families.
Yes, I know.
And you're wanting to be more aggressive.
Just because I feel like this is a no-brainer on this one. I don't know how low it's going to go, but I just know that this is not going to last. That's all.
It's not going to last. Yeah, the earnings season's too strong.
So between the two of us, we should get it right. Thank you for joining. Like us on Facebook. Subscribe to our YouTube channel, because we always post our Finance Fridays on there, and I do like little 90-second tip videos on a whole bunch of stuff. Follow us on Twitter at Nova Wealth Management, MGMT. We always post daily, really cool tips. I think they're cool. I think they're cool statistics going back in history. That's the kids.
Yeah.
He's got to answer that. All right, everybody have an awesome day. We'll do something for Finance Friday tomorrow. I don't even know what we're doing yet.
We'll probably do this. Hopefully we
I don't
won't
know.
be down
Hopefully
another
it's not another
1,000
points. Thanks, guys. Have a nice night.
Hello.